Okay, good morning students. Welcome to the first video in the set of videos that we're gonna post for you guys on the Moodle site to help us complete the semester and if continues to complete the year. I hope you're all doing well and I hope you're still keeping safe at home. There's two chapters that I want to finish before the end of the semester. Chapter 8 was the one that we're busy with, so there's still a couple of things I want to do with you regarding the general ledger and the trial balance. And then I also still want to finish the VAT chapter with you. If we can finish those two chapters for this first semester, then we will have efficient time to finish the rest of the chapters in the second semester if face-to-face resumes, or if we continue with online, I will post then obviously a new plan for the rest of the chapters as well. So for now the planning has just gone up until the end of the semester. We will see what the situation is after that. But I can assure you that we will work together and we will do our best to make sure that we finish this year and that no student is left behind. If at any time during this process you feel that you need to contact me regarding anything or ask questions, I will try and be available from the 2nd of May online every day from 9 to 3. So you can contact me over email or on the Moodle site if it needs be. And we can set up consultations. Might be over Teams or might be on Moodle, so we can see what we can do or how I can assist you. Okay, so this video will speak to the returns of goods, the two scenarios for the returns of goods, and we're still doing the general ledger, so how this will be recorded in the general ledger. The returns of goods will look at two sections, the purchase returns and the sales returns. So when I buy something and I'm not happy and I'm sending it back, or when I sell something and the customer is not happy and they send it back, how do we record all of this in the general ledger account? Now you'll find this on page 177 in your green books, and the examples will start on page 181, the purchase returns. Okay, so I'm just going to talk a little bit about purchase returns first, and then we'll do the example, and then we're going to do exactly the same with the sales returns. Okay, so the purchase returns is the section where we buy goods from the supplier, goods that we're going to use in the process of completing jobs. These goods can be purchased for cash and on credit. So the example will deal with both the cash and credit purchase of goods and what the process is when these goods are returned. When we return goods, this account is called the purchase returns account. This account at the end of your reporting period, if you're reporting monthly or 6 monthly or annually, will be closed off, and I'll show you how it's closed off to ultimately show the effect on the purchases account. So what happened to my actual material? Did it go up or down with the purchases, etc., and to get to see exactly how much material we have left in our account. Okay, so to do this example, I'm going to refer to the example on page 181 and 182. You'll see there's two transactions over there, transaction number 1 and transaction number 2. One is obviously a cash transaction and one is a credit transaction, so we can cover both of those types of accounts. Okay, so firstly, to do returns, obviously you had to have purchased material. You have to have materials to return, otherwise you can't do a return. You can't send something back that you don't have. So that I'm not going to do the actual recording of purchasing of materials. I'll just show you how it was done. If I buy materials on credit, my materials will go up. So debit building materials, it's on credit, so account payables, and credit the accounts payable account. And the same when I buy material for cash, my material will go up. So debit the building material and credit the bank account. So that was just the purchase of material. So now I can see this is the inventory I have in my account. I made a credit purchase, I made a cash purchase, so this is sitting there. That's just normal entries that you've done plenty of times, so there's nothing new in that account yet. Okay, now if you look at the first transaction and the second transaction, there's two returns that's going to happen. I'm going to return goods to the value of 750 Rand that I've purchased on credit before, and I'm going to return goods to the value of 240 Rand that I've purchased on cash in the past. So that's the two returns I'm going to be dealing with. So let's start with the credit purchase. When this material was purchased, remember, accounts payable is a liability account, so it's a minus and a plus. Debit side is a minus, credit side is a plus. So when I bought this on credit, my debt went up. I now owe this money to the supplier for the building material that I purchased. But now I'm not happy with the goods that I have. There's many different reasons. It could have arrived at the business in a bad condition, could have been damaged. It could be that it's not the goods that you've ordered, so it's the wrong goods. It could be that it's of the wrong quantity. So there's many different reasons why I'll return goods. That is not important for now. But if I return goods, what is going to happen to my debt? If I return goods, my debt must decrease. I'm not going to pay for something that I'm sending back. So I will debit my debt account, my accounts payable. Remember, it's a minus plus. So my debt will go down on the debit side. So debit accounts payable. The contra account will be purchase returns. If I debit one account, we know the double entry principle says if I debit something, I have to credit something. So therefore, I'm going to credit purchase returns with the 750. Contra account is accounts payable. So I can clearly see that this return of goods was for goods that I've purchased on credit. That's why it's accounts payable. Debit accounts payable, credit purchase returns. The same scenario will be true if we look at the cash purchase. I bought materials for cash. There's the cash purchase that have happened. I'm not happy with some of the goods that I've purchased, so I'm going to send back the goods and I'm going to get back my money. So debit the bank account, money comes back into the bank account, plus minus, it's an asset, remember, so plus minus. Debit the bank because the goods come back with purchase returns, and then credit purchase returns. There's the two accounts. You can follow the colors to see what is debited and credited. Remember to stick to the double entry principle. So we can have cash returns and we have credit returns. For the cash returns, we return it out of the accounts payable account. For the credit returns, we do it out of the accounts payable account. And for the cash returns, we do it out of the bank account. Okay, so that's the returns. But now you're going to ask me, if we make returns, then obviously the material we bought, the material that was in our storeroom is now going back. And so far we haven't adjusted the building material account at all. So nothing has happened with our building material account. So it looks like we still have all these goods purchased on credit and these goods purchased on cash. So somehow we still have to adjust the building material account. Now this is where the closing off of the purchase returns account will come into play. You will make all of your returns for the period, if it's the year or for the month or however you report, and all of the returns will now be listed on the credit side. You will then add up all of these returns. So in this scenario, the credit return of 750 and the cash return of 240. So in total for the month or for the year, for the period, I've returned goods to the value of 990. I will then take that total of 990 and take it out of the building materials account. So the total of 990 will now go to building materials, debit purchase returns, and credit the building material account. So what did I do now with my building materials account? Remember, this is an asset, so it's plus minus. If I make a credit entry in my purchase returns account, it means the goods will go down. Why? Because I send them back to the supplier. I don't have those materials anymore. I made a return. So that's why the total will be credited to the building materials account, and obviously purchase returns is debited. I stuck to my double entry principle, and I've now completed my returns on purchases for the period. Okay, scenario 2, we'll then now look at the sales returns, the opposite side of the coin. The first one was purchase returns, so when we bought something and we weren't happy and we were returning it to the suppliers. Now we're going to have a look at sales returns. So when the customers, if you did a job for the customers and you completed the job, but they were not happy with some of the material you used, or they were not happy with some of the building work you did, they can ask for refunds or returns on the job that you did. So we also have to deal with the opposite side, the sales returns. It's also sometimes called returns inwards because the returns comes back to your business whereas purchase returns will be called returns outwards because you're sending it out back to the supplier. Okay, this example is on page 180, and there's also two transactions similar to the purchase returns. We will deal with a cash return and a credit return for sales. So a cash transaction and a credit transaction for sales. Okay, firstly, obviously, we have to have made the sale for something to be returned, because if there's no sale, nothing can be returned. So you could look at the normal entry that you've done so many times before. If you make a cash sale or a credit sale to a customer, if I sell something on credit, we know it will be accounts receivable. We debit accounts receivable and we credit contract sales. And when we make a cash sale, we debit bank money, goes into the bank account, and we credit sales. So we can see that we've made two sales. We made a credit sale to a customer that still owes us money, and we also made a cash sale to a customer who's paid us already. Okay, so now what happens if they were not happy? They've done an inspection. They're not happy with some part of the job that you did or happy with the materials that you used. They can now ask for returns or refunds. Let's look at the credit one first. So this person still owes you money. He's not happy with some of the work that you've done. He will not pay you the full amount. He's going to ask for a refund or for a return. So his debt must become less. His debt must become less. So let's have a look at the accounts receivable account. There's the debt. That's how much he owes you at this stage. He's not going to pay the full amount because he wasn't happy with the goods. You allow the return. So now we're going to credit accounts receivable with the 500 Rand that he's returning on the credit sale. Contra account will obviously be sales return. So credit accounts receivable. Double entry principle tells me that I need a corresponding debit. So if you look at sales returns, there's your debit entry. Credit accounts receivable, debit sales returns. Contra account is accounts receivable because it was a credit transaction that was refunded or returned. The same will be true for the cash sale. We made a cash sale, so money came into the bank account. Now they ask for a refund, weren't happy with some of the goods, so we're going to send some money back to him, a sale return. So now money will go out of the bank, minus side of bank. Remember, both of these accounts are assets, so plus, minus, and plus, minus. So now we're going to send money back to him. So money out of bank, the return was worth 650, or the refund was worth 650. Credit bank, debit sales returns. So there is the return for the cash sale that you've made. So if we look at the sales returns in our account, credit sales were returned to the value of 500. Cash sales were refunded to the value of 650. So now the scenario is similar to the one we had for the purchase returns. When we made the purchase returns, the inventory account had to be adjusted because obviously the inventory was sent back to the supplier. Now we have to adjust the sales account because currently in the sales account, it still says there's the credit sale, there's the cash sale. It doesn't say anything about the returns. So what are we going to do with the returns? Once you've made all of your cash and credit returns for the month, we're going to add the total together, and the total of the returns will be sent back to the contract sales account. So 500 was a credit return, 650 was a cash return. Total returns was 1150. So we'll send that total of 1150 out of the contract sales account. Total of 1150. A return was made. The total return was worth 1150. Okay, so in summary for the sales returns, we get credit sales and cash sales. So therefore the returns can be on the credit sales and the cash sales. Credit sales taken out of accounts receivable and into sales returns. Cash sales taken out of the bank account and into sales returns. Once you've done all of your sales returns for the period, take the total, 500 plus the 650, the 1150, to the sales account. We take it out of sales. We can't recognize that sale anymore because it was returned. So we minus it from the sales that have already happened. Okay, so that's the end of our first video. I will do an exercise with you to show you how these returns works with all of the other transactions. Make sure you go through this video a few times and make sure you're happy with the workings of returns. It's going to be included in your general ledger entries from now on. I do apologize if there's any buy sounds. This is the thing for working from home. There's kids and there's dogs and there's people, so I do apologize if there's any extra noise.